Let's talk about the next level of risk that I would say the majority of people live in and are comfortable staying here because someone else is managing your money for you. Um, we may stay in the low to medium risk levels for some time and realize that we aren't making money fast enough and start to talk to others about investing and how they get ahead. Well, we start to explore a private financial advisor and sometimes hire them, or we just stay with the bank that we've been working with all along and work with one of their internal financial advisors to learn more and invest our money. Let's call this the investor risk profile, where we invest in mutual funds, which we purchase with the assistance and guidance of a financial advisor. As the consumer risk profile expands, financial advisors, or FAs, will continually massage the investor's capital allocation across the different mutual fund asset classes in attempts to generate better returns and keep risk reward in check. This can make the rate of return vary quite a bit based on the asset class allocation, and on average between 3 to 12%, depending on how risk averse it is. Commonly, the average consumer is comfortable in this area of risk profile and blends their money and savings into the 3 different risk levels: low, medium, and high risk. We tend to spend most of our time in this space because we start to see value and trust in the relationship with our financial advisor or FA, and they are helping us make more money than we could have just by saving cash in the bank. And the mutual fund industry is a lucrative money-making industry and is highly regulated by the government with licensing and certifications required to advise you where you should invest your money. I've always kind of questioned why the government allows a profession like this to advise where I should invest my money and, be wrong and still be allowed to charge a fee for it. Shouldn't a bad performance revoke the service you paid for? I guess it's similar to the weather forecasting. They can be wrong more times than right and still get paid well, right? Well, anyway, either way, in Canada, this is the highest level that uses a licensed advisor or professional to determine your risk profile and manage your money. This is likely just another reason why most of us are comfortable in this blend of profiles, because someone else is looking after your money and it's endorsed by the government and its financial industry regulations. So this works well when markets are going up. Statistically, over long term of 10 to 15 years, the overall market has generally gone up. What I can teach you is that you can still make money also when the markets go down. Wouldn't that be a great thing to know? When markets are going down and most people are losing money, but you learn how to make money in a down market. I know. So much to learn, right? Well, once you take the step to start self-managing your own money, I think you should periodically reflect in on your performance and evaluate your own risk profile. Because remember, this is technically what your financial advisor is doing for their fee that they charge, and you're now going to be doing it yourself. So I encourage you to incorporate a reflection process for yourself once you take on that responsibility.